So we want to get back to our discussion today of this history of basically banking, and I think we'll finish that up in just the next few minutes. The GlassSteagall Act was passed in 1933. You remember it created this firewall, or this separation between banking and all other industries. And the reaction to that was bankers didn't like it. We talked last time about how they set up bank holding companies, and the bank holding company would own a bank, but then the bank wouldn't get into these other activities. It would be the bank holding company would set up subsidiaries to get into these other activities. Right? And I believe I had this picture. Bank holding company would own a bank and then would also own some subsidiary. And that subsidiary would get into the quote, non-banking activities. And that didn't go on very long until we got a Bank Holding Company Act of 1970. You remember we had already had a Bank Holding Company Act of 1956, and it regulated the multi-bank bank holding companies, the bank holding companies that were set up to get around the McFadden Act, the ones that were set up to allow banks to jump over state borders, not by the bank opening a branch in the next state, but by the bank holding company owning banks in various states. And so then we said, no, you can't do that. The bank holding company is confined to a single state also. Anyway, so now here we have bank holding companies that are getting into non-banking activities. The bank was prohibited from getting into some non-banking activities, so now the bank holding company will do that. And so we get an act, and it says the Federal Reserve is the regulator of bank holding companies, and then the Federal Reserve will be the one that decides whether this subsidiary is legal or not. And legal or not will be basically the same criteria that were used with GlassSteagall. Is the bank holding company obeying GlassSteagall? I believe where I ended last time was to say that the Federal Reserve was very skeptical. The Federal Reserve it's run by economists, PhD economists, for the most part, and there's no law that says that. That's the way it works out. But these PhD economists who had studied this topic of the Great Depression, the bank failures, and so forth, and they said, you know, we're not persuaded that banks getting involved in other types of activities, that was the cause of the Great Depression. And so we are not going to be as harsh on these banks. So when banks come along and apply, can I open a subsidiary? The answer will frequently be yes. And so the Federal Reserve, in regulating bank holding companies, came up with a list of permissible bank activities. I'll just say permissible activities. And the Federal Reserve put some things on that list and said, if it's on this list, you need to notify us when you do these things. You know, when you set up a subsidiary to get involved in these things, you need to notify us, but don't worry about getting permission. We're going to give you permission on that. And then as time went by, the list of things that they got permission to do just grew longer and longer. Okay, now, let me give you an idea of the type of logic, and we'll just kind of pick something out here, the type of logic that would be applied. The bank would come to, or I should say the bank holding company. You remember, the bank holding company is run by the same people that are running the bank. You would just be made an official of the bank holding company rather than the bank president or CEO. You're the bank holding company president or CEO. So the bank would come to the Federal Reserve and say, you know, we would like to, let's say, operate an armored car service. We would like to go out and buy or armored truck. We'd like to buy some trucks and get them all beefed up with a lot of iron and so forth to make them, you know, like impermeable to bullets, thick glass, get some guards carrying the guns, and we'd like to carry money around town. And the Federal Reserve said in the early days, well, how is that closely related to banking? Why should we allow you to do that? And they said, well, look, we've got a customer as a bank, and they've got a deposit here, and if they call us up and want some money, we need to be able to carry money to our customer. This is just a direct extension of our banking business, carrying money to a customer. Yeah, we can see that. Okay, well, now that we've got this truck and the guards and blah, 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 all this stuff that goes with it, Well, then how about letting us use that truck and the guards and all the stuff that we've already acquired to service our customer? How about letting us use that and basically sell that service to other people? Like if another bank wants to deliver money to their customer, could that other bank call us up and say, hey, send your truck over, pick up some cash, and deliver it? And the Federal Reserve said, well, you know, you were doing this stuff to service your own customers. It's not like you've gone out there and established a business that's unrelated to banking. You were already doing this. And now all you want to do is just, when the truck is sitting idle and not being used, you want to use it to deliver money over here. Yeah, it's pretty closely related to your banking activities. Go ahead. And so then it goes on the list. And so then, at some point, some banker goes to the Federal Reserve and makes application. They say, hey, we've got this trust department, and which is totally legal. You know, I mean, banks have a trust department. Trust department is this. You turn your money over to the bank with instructions and say something like, I've got this money, I want to set it up, I want you to pay this out to my beneficiaries. I'd like you to pay each one of my kids $5,000 a month, kind of an allowance or something like that. Or I want you to take this money and manage it, you know, invest it for me, and then pay money to my grandkids or whatever. So we've got a trust department. And one of the things that we do for our customers, ordinary part of banking, one of the things that we do is we calculate their taxes at the end of the year. You know, we're handling their finances. They've turned their money over to us. And they have to calculate taxes, so we're helping them with that. And the Federal Reserve says, no problem. And then the banker says, well, now that we have got these experts that know how to calculate taxes, and they're helping these customers out, how about if somebody come in off the sidewalk and ask us to calculate their taxes? Could we do that? Yeah, that's the same activity. It's just a matter of somebody coming in off the sidewalk rather than a customer you already have, but it's the same activity. Okay, we'd allow that. And so this list keeps growing. It's things bankers are already doing for their customers, and now they want to do it for strangers. That's not so strange. And so the list gets longer and longer and longer. Okay? Now, after a while, bankers start saying things like this. Hey, let's add one to the list down here that we kind of like. We would like to sell insurance. That is to say, we want to set up a subsidiary that would sell insurance. And we're mainly talking about, I'll say the word casualty insurance. Casualty insurance is not life insurance. We're not insuring people's lives, but casualty insurance would insure property. We'll insure homes. We'll insure businesses, you know, like equipment that the business might have, vehicles and so forth, computers, buildings, structures. We'd like to do that. Well, I don't know what the Federal Reserve would have said if they were just left on their own, but let me tell you, that insurance company said, no, this is evil. And insurance companies are regulated at the state level. And so one problem there is the Federal Reserve saying to bankers, yeah, go ahead and get in the insurance business. And then the state of Illinois or Arkansas or Missouri or Kansas or Texas, wherever, go, just a second, who do you think you are? We regulate insurance companies in this state. And part of the problem is the insurance companies do not like competition. And so then they just squawked. They squawked at the state level. They went to congressmen, congresswomen, and representatives and said, oh, you've got to block this. The Federal Reserve is getting ready to let bankers in our business, and they are going to compete with us and put us out of business. Maybe make it where nobody can make a profit in this business. You've got to stop it. Well, bank holding companies tried to get into the insurance business for years and years and years. And I don't mean to say 100 years, but year after year, it just went on and on and on, 10, 15 years. And it was always this kind of standoff. And by the way, there were other things that bankers wanted to do. They wanted to get into the brokerage business. I'll say stock and bond. They wanted to say, oh, call us up, tell us that you want to buy some stock in General Electric or whatever, but just place your order. We'll buy that stock on your behalf and deliver it to you, but and charge you a fee. We will become a stockbroker. And then the brokerage firm said, no, 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 don't let those guys do that. This would be evil. Evil to who? Well, we don't want the competition. And then there'd be like the investment banks. You know, they got that word, a bank in it, but an investment bank is not a bank the way we have been talking about banks. Here's what a bank is, a commercial bank. It takes in deposits and makes loans, right? Well, an investment bank is this. An investment bank's key service is helping companies do a couple of things. One thing it helps companies do is issue stocks and bonds. So if like you have a company over here and you say, gosh, we're trying to grow our company. We need some finance, some capital. Then we could go to an investment bank and say, hey, help us. Give us the ins and outs of it about issuing some stock to the public, or help us issue a bond to the public. And then the investment bank would say, oh, okay, we'll help you with that. And then the investment bank would be an advisor and then to this company. And then the investment bank would say, okay, now that we've got these stocks or bonds all printed up, what we're going to do is we're going to go out there and find investors that are interested in these stocks and bonds. And we'll help you sell these things, place them, find investors. And one specific activity that they were very involved in, you know, you mainly think about companies wanting to sell stocks and bonds so they can build a new factory or so they can grow or something like this. One thing is called M&A, mergers and acquisitions. What investment banks would do is some company might come in and say, hey, we want to buy up that other company over there. We've got an airline, we want to buy that other airline. Right now they are, let's say, competing with us, or maybe that other airline is serving cities that we don't serve. We want to merge with them. Help us do that. And so then you go to an investment bank and they say, okay, here's our advice. We'll maybe print up some stocks, or maybe what we'll do is we'll go and help you arrange a loan. We'll get a bunch of money and then we will buy that other airline. We'll help you buy it. Acquisition. So anyway, investment banks. And bankers are saying, hey, we ought to get in that business. That sounds pretty good. They're making lots of money. So anyway, in each case, bankers were getting in these things like we can help people calculate their taxes, and we can operate an armored car service and things like this. ATM machines and sell the services. We can do those things. And then they start saying, this is pretty closely related to banking. Why don't you let us set up a subsidiary that would do these things? And the problem is, this is not like creating a new business and this is, you know, adding these things. And it's not like going out and competing against a few small companies. This is like, these are enormous businesses with a lot of political influence. And they are all just telling Congress, don't allow those bankers in our business. Evil. And then they have all sorts of terrible things that would result, you know, if banks were allowed in these businesses. Meanwhile, while they are saying, no, 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 GlassSteagall, don't let those subsidiaries, or don't let those bank holding companies get in our business. Meanwhile, while they're doing that, each one of them is trying to buy banks. They want to get in the banking business. They just don't want the banks in their business. And so there's this really, and the bankers don't want them in the banking business. They just want banks to get in this business. So everybody's just hypocritical as can be. Why? Because it comes down to money. Yeah, the rules should allow me to sell insurance, but not let insurance companies sell banking services. Yeah, okay. And the insurance companies are saying, no, those bankers shouldn't be selling insurance, but we ought to be able to own a bank. What's the matter with that? This just goes on and on and on. And there's these powerful political forces on either side of it. And so basically for 10 or 12 years, there was this sort of, you know, situation that was just not working out. Okay, so what happened? So what happened is this. In 1998, two companies got together, just conversations at first. One of them is Citicorp, and it was a bank holding company, And it owned a bank. Of course, bank holding companies do that, or else we wouldn't call them a bank holding company. And its bank was Citibank. I double dotted that one eye. So here's Citicorp. It's a bank holding company. It owns this big bank. And it depends on what year you looked at, but it's the number 1 or number 2 or number 3 biggest bank in the United States for like the last 50 years, 75 years. So a huge bank. And then they got into a conversation with Travelers Insurance, maybe group. And this is the CEOs of each one of these, and these are huge companies. We're talking hundreds of billions of dollars on either side of the deal. And so they get involved in this conversations, just sitting around kind of talking. And I've already talked to you about some of the shortcomings of Glass-Steagall. Doesn't allow diversification, doesn't allow them to achieve economies or efficiencies in managing their companies. And it didn't allow them to cross-market products. So these two get together and they say, oh, that is so sad that we can't basically have a single company because, you know, Citibank has got offices around the world, branches, and it's got lots of big businesses as customers that it's lending money to. And those big businesses, both in the United States and elsewhere, those big businesses, they need insurance. And it's too bad that when somebody comes in and says, hey, I want a loan for $300 million or whatever, that you can't say, oh, well, it's sort of like going to McDonald's. You want fries to go with that? So you come in, you say, I want a big loan. They say, you want fries to go with that? You want insurance to go with that? You're going to build a big building, you need to insure that building. Well, we can't do that because Citibank can't sell insurance. And Citi says to Travelers, it's too bad when somebody comes in and says, gosh, we need a lot of insurance, that we can't say, well, would you like a loan? Or do you need some maybe banking services, checking account services, transferred money around the world for you and stuff like that? Can't do it because that's a different business, insurance. Some of these economies of scope would be economies of, we need some expertise, and one expert or maybe one group of experts could provide help to these people in managing money because that's what they do. Insurance companies are taking in premiums. I mean, what we mainly think about insurance companies is they bring in a premium, you pay them, and then they pay out if a building burns down. And they do that. But the point is they bring the money in today and the building doesn't burn down for 17 years. Right? And so what happens is you pay your premiums today and they're investing this money. Okay? Well, so maybe some experts that will help them invest this money, those same experts would help the banks invest their money. Because they're bringing in deposits and then making loans and, hey, where's a good place to loan? Or should we be buying bonds or whatever? We're making investment decisions. Too bad we can't have one group of experts, financial experts, economists and so forth, help out both groups. Yeah, but you can't just hire two groups of experts. That's not efficient. Too bad we can't just have one big office in New York City, that we got to have a big office for this company in New York and a big office for this company in New York. Rent is high in New York, and we're talking about lots of people. Too bad we can't consolidate these offices, bring them together, maybe save, just in New York alone, maybe save 10, 20, 30, $40 million a year in rent. Too bad. So these guys are sitting around talking. And then they say, hey, got an idea. I'm thinking Martinis are involved. Because these are the kinds of ideas that, you know, sober people don't come up with. And what they say is this: hey, got an idea. This is totally illegal, so don't tell anybody. But let's merge anyway. Because if you go and you read the GlassSteagall Act and read between the lines, it basically says this: if a company is breaking Glass-Steagall, they've got 5 years to come into compliance or else. If you get a company that is doing things it's not supposed to do, then 5 years from, that's all they got to break those companies apart. And so what they said is, okay, well, let's break Glass-Steagall. Let's just merge. And then 5 years from now, we'll break the company apart in compliance with Glass-Steagall if the law doesn't change. And they said, yeah, okay, let's do that. And now their total assets are in the hundreds of billions, but their net worth, like what it would take to buy, they call that the market cap or capitalization, what it would take to buy all the stock in these two companies in the marketplace, it's not in the hundreds of billions, but I mean it's billions and billions and billions, I don't know, maybe 50, 75, $100 billion to buy all the shares of stock into both companies. We're talking like big operation here. And so they just say, let's take these, and these are two of the biggest, like if you just said, let's make a list of the top 10 biggest financial companies in the United States, these would both be on it. And so what they say is, and this is pretty gutsy stuff, by the way, right? Taking this really conservative company that's got a lot to risk. Like you can take a company that's small and nobody's ever heard of, and if you ruin it, then people go, eh. But if you have something that's really safe and secure and worth a lot, this really great asset, and then you do something really reckless and irresponsible, I mean, Congress can pass the death penalty in a sense, Congress and the regulators and so forth. So they were taking a real gutsy move here. And so they just say, well, let's merge. And then we will tell our regulator, we'll tell the world that, oh, if this is not permitted, then 5 years from now we will break up. And what they were betting on is that this merger of these two huge companies will be the thing that will break this logjam and get everything moving for deregulation. And so they merged. And they were betting that by 2003, Glass-Steagall would be, if not eliminated, modified. So that's what they did. Now, as soon as they did that, they started spending lots of money and a lot of political capital trying to get that law changed because they had a lot riding on that. And then as soon as they did this, the other insurance companies said, hey, we ought to do that. And the other bank said, hey, we ought to do that. And not only did the other bank say, hey, we ought to do that, get with an insurance company, why not get with some brokerage company? Or why not get with some investment bank? Hey, we ought to do that. Why don't we give that a shot? See if we can't get 5 years. And so all of a sudden the dynamic changed. It's not these two groups that are facing each other off and each one of them saying, stay away, stay away, stay away. Now two of the leading companies in these two different sides got together and said, hey, let's get a 5-year head start on everybody. If it does change by 2003, we're together, we hit the ground running, and everybody else would just come on board then. So, well, the others say, let's do the same. And all of a sudden, we get these financial companies that are trying to get together. And that did lead to Congress changing the law. The Federal Reserve is saying, this is not that bad of a deal. There's a lot of logic behind it. They can save a lot of money. They can, like achieve efficiencies, lower their cost of doing business. And so we kind of go along with this, the Federal Reserve saying to the Congress. And so there was a lot of political pressure, and Glass-Steagall then it's not like they just went in with a big eraser and erased it. And usually it's described as the elimination or the repeal of Glass-Steagall. It's really a rewording of Glass-Steagall and like taking a lot of that firewall down and making a lot of those rules, that separation, a lot less severe. And this, in 1999, Graham, Leach, Bliley, B-L-I-L-E-Y Act. And it's very often called the repeal of Glass-Steagall, but like I say, Glass-Steagall still exists, but it is just the watering down of Glass-Steagall. And so these major laws, 1927, 1933, these major laws that were passed only 6 years apart, that were basically getting rid of interstate banking and forcing banks to just stay within their own domain and keeping them separated from everybody else. Those laws, 5 years apart, 1994 and then 1999, we basically reversed all that. And banks were allowed to cross state borders through mergers, and banks were allowed to basically jump across those other boundaries into other industries. Here's my little story on this, because I had a little bit of experience about that relates to this. What happens, we're in the St. Louis Federal Reserve District here, and so there's a president of each Federal Reserve Bank. We have 12 Federal Reserve banks, each one has a president, and the president goes around and makes a tour of the district. And so they'll come to, smaller cities. Most every city in the district is smaller than St. Louis. But anyway, make a tour of different cities and just come into town, meet the bankers and other prominent citizens. I was there, so I don't know if that term would apply. Anyway, and so I went to this meeting, and there was dinner, and then after dinner, I go into a room, and there's maybe 40 or 50 the mayor was there, and city manager, and a couple people from the city council, and a couple of us were there, economists that teach here in the city. And there were maybe 30 bankers there, because those bankers want to meet the president of their Federal Reserve District. That's kind of their regulator, and so they want to be on good terms with him. He's an economist, and I sat next to him at dinner and had like a chat. I had used a textbook that he wrote years ago when he was a college professor. And so we chatted and all that kind of stuff. And so that was all over with. And we went into this room, and it was a question and answer session. And so people were asking questions, about various laws or regulations, many of which I'd never heard about. And so this had been announced, this, quote, illegal merger had been announced, and I was still kind of trying to understand what's going on. Okay, so they did something that's illegal, but they've got 5 years to undo it. And I was trying to come to grips with that. So I'm sitting in the room, and we go around, and the bankers are asking about this, that, and the other. And then after a while, there's kind of a lull in the conversation, and I raised my hand. And I said, I want to ask about this whole deal right here. I said, of course, I don't have any inside information, but it seems to me like if you've got a bank and it's worth, let's just say the market capitalization, all the stock might be worth $50 billion, and you've got some insurance company and all of its stock, its market capitalization might be $30 billion. I don't know, but let's just use numbers like that. It seems to me like if you've got these two huge companies and they are regulated so much, and they've got so much to lose, if they just go out and break the law and go, how do you like that? It doesn't seem like they would have just done that. It seems to me like they would have gone to the Federal Reserve and said, hey, what do you think about this? And got any advice? Got any guidance you can offer? Any insights? Is this going to be a problem? And when I say go to the Federal Reserve, I don't mean to say in St. Louis, because there are these branch offices around the United States, 12 district offices. But the Federal Reserve Board is in Washington, D.C. So I'm thinking, and that's the way I expressed it, is it seems like before they made this gutsy move, they would have gone to the Federal Reserve and said, let's have kind of a quiet dinner conversation and just kind of bring this issue up and see what the reaction is. What do you think? That's what I said. Do you think they did that? And the room really cold. And the president of the St. Louis Federal Reserve Bank said, absolutely not. The law is established by Congress. We were created by Congress, we, the Federal Reserve. We work for the Congress, not on a daily basis. We don't answer to them for what we do on a daily basis, but we were created by the Congress. We can be changed by the Congress, abolished by the Congress. We, the Federal Reserve, would not be meeting behind closed doors with some bank, helping them break some law. Absolutely not. And then, he said this to me like that. And then when he got done, I thought, boy, that was pretty bad, And I'm kind of going like this. And then he turns and he's got a vice president there who is their legal vice president. And then it was a woman, and she stood up there. Absolutely not. There is no way this would happen. And I mean, and I'm just kind of going, oh my God, everybody in the room is looking at me like, why did you say such a thing? Anyway, I said, well, like I said, I don't have any inside information. I just thought this would make sense to do something like that because it's but it didn't happen, okay? And I said, okay, fine. And then I shut up for the rest of the meeting. Anyway, so the next morning I came to the office, and I was kind of embarrassed. I talked to this colleague of mine about it later. I thought, oh my God, I wish I hadn't asked that question. He goes, yeah, that was pretty dumb. So anyway, the next day I came to the office. I got out the Wall Street Journal, and on the first page, column 6, at the right-hand column, it had just been released, and now there's a story on the first page of the Wall Street Journal that Citicorp and Travelers Insurance had met with the Federal Reserve Board, behind closed doors, and sought their advice and opinions, and all of the stuff that they had just said, no way did that happen, that would be wrong. They had done it all. And the Federal Reserve was basically working with them to try to find a way, but I mean, not telling them to do it, but just giving advice and insight, because the Federal Reserve, the way it was managed and the people that ran it, thought that list ought to be longer and that there ought to be more competition in the financial services. Economists like competition, and that is really another way of looking at all this. It is, how do we have more competition in the insurance business, more competition in brokerage, more competition in investment banks? How do we get more competition in the banking industry? And so the Federal Reserve, as economists, are leaned pretty heavily toward, let's increase competition. Anyway, this did break the log jam. And we did get this act in the next year, and since then there has been this merging of the financial services industries, and there's a term about a financial supermarket, but the whole idea would be, and it's a dream, I don't know how much further we'll go in that direction, is that you can just kind of imagine some big supermarket, and there's a bank in there, and then there's insurance, and then here's a brokerage, and then here, but basically a big financial company that can take care of all your financial needs. And that is the dream of some of these people that are doing this stuff. And so we've talked about them achieving economies of scope. There's also this issue of diversification of risk, reducing risk of the company. And there's one other motive or reason for bringing these companies together, and it's not an economic thing, but there is empire building, or in 3 letters, ego. There's just, I want to run the biggest damn company in the world, kind of a thinking. And this is very common thinking among people who are already running pretty big companies. They're just thinking, what would it take for me to make my company twice as big? And then guess what? After it's twice as big, they want twice as big again. And it's very difficult to satisfy those desires. There was a guy named Sandy Wheel that ran this company, Travelers, and he had started off with a much, much smaller company 20 years before, and he just started buying out and merging with other companies and basically kicking out the guy, like if you bring 2 companies together, you say, no, we'll be partners, you run your part, I'll run my part, and then you get them together and then you do something to engineer a coup where that guy's out and then you run the whole thing. And this guy was pretty good at that. And so then he got a bigger company and he merged with somebody else, and then somehow or another they had to go. And sometimes pay them off. Just give them money and say, leave, here's $10 million or whatever, and they go, okay. And sometimes it's go to the board of directors and say, this guy is totally incompetent. We can't have him running a company, I got to do it all. Okay. And so then he just started doing a series of these mergers, and not like one every year, but a series of mergers, and he just started building a bigger and bigger and bigger company. And finally, he had the biggest company in the insurance industry. And then he said, wow, let's get together with this guy. I'm already the biggest in insurance. Let's be the biggest of all financial companies. And so this guy that ran this company is John Reed. He kind of thought the same thing. I'd like to get in that insurance business. This would be the biggest company in the world. And this guy's kind of old. John Reed was 15, 20 years younger. And he thinks, well, let's just merge, and I'll hang out, and I'll be the number 2 guy in this merged organization. Okay? Citigroup. I'll be the number 2 guy in this big organization, and Sandy's pretty close to retirement age. He'll probably retire in 5, 6 years. And when he retires, I'll take over. So they merge it all together, and then Sandy's got the ego working for him. He's number 1 today. And then this John Reed's number 2. He'll be number 1 in a few years. And so what happens is they get together, and they're going along for a while. What do you know? John Reed loses his job. He's gone. And this Sandy Wild, then he ran the whole company. And so, ego. And then he finally did retire, and somebody took over from him. And the company started having financial problems and more. And then that guy lost his job just from, I don't want to say incompetence, because who knows if anybody could have managed it, but they got into some problems, and that guy lost his job, so somebody else took over for him, and that guy's in trouble today. And what that maybe says is you can build an empire where it's too big, and it just becomes unmanageable. You know, these economies of scope, we want to get into all different kinds of business. It may be that you get into businesses you just don't understand and that you just can't manage them, and you take risks that you just shouldn't be taking, and that you know how to run a bank, and you know how to deal with these things that we talked about, with the information asymmetries and how to make good loans and so forth, and how to collect on those loans, and you know how to do that better than anybody, but that doesn't mean you know how to run a brokerage company or an investment bank or an insurance company. And for sure, you can go out and hire people to do those things, but then there may be a point where they want to do something and you don't like it, and then what you say is, no, you do it my way. I'm the boss. And then, oops, we made a mistake. And then, whoops, we made a mistake means we lost $1 billion. Oops. Or 10 billion or more. And then when you do that, you got to tell the shareholders, and the shareholders say, we don't need any more of that. You're out. And so what I'm saying to you is economies of scope. There's no textbook that tells us how far you can go and achieve economies of scope and how that pays off for the company. We have to find this out. GlassSteagall didn't say we're going to find out. GlassSteagall said this, the scope is going to be limited to this. And so we're not going to find out how far your managerial talents could be spread and still make a profit. GlassSteagall said that's it. But as soon as we lower the barriers and we let that bank start getting into all these other businesses, we have found out that, you know, it is possible for that company, that big financial company, to just get into businesses they cannot manage. That's beyond their expertise. And, you know, that comes down to this whole empire building and ego idea. You're going to say something? No? So anyway, that's a little bit of this story. But nowadays, when these companies lose money, it started in, 2007, went into 2008, part of 2009. What happened is these big companies, and I don't mean to just focus on this one, but this was the one that broke the logjam that got us to, quote, repeal GlassSteagall, and that's why it's getting all the focus. But these big companies in 07, 08, 09, they started making decisions, you know, like making decisions over in all these peripheral areas. They started making decisions that were so bad, their losses would be in the order of 20, 40, 60, 80, $100 billion. And that's the kind of stuff that just make them go out of business. And so even if GlassSteagall was premised on the wrong idea to begin with, this idea of keeping banks out of everything else, all these other businesses, maybe wasn't a bad instinct totally, because when we repealed that GlassSteagall and we let those banks get into everything else, it didn't take very many years, a decade, until, sure enough, they were at the point of going out of business. And then what happened? Taxpayers stood up, handed a bunch of money over to these institutions to keep them in business. How much is a bunch of money? A bunch. You know, like if you'd fill up this room with $100 bills, we'd need to get billed onto this room. And I think some of these $50 billion and up, I'll put a plus sign in there, we're handing over to these companies to keep them in business. Now, in theory, they're going to give all that back. And so this was something to tide them over. Boy, that tied me over. But something to tide them over through this rough time that they were going through. But the rough time they were going through was partly of their own making. They just made a bunch of bad decisions. Now, a lot of criticism of that. Should we have done that? My answer is, yeah. We shouldn't have let them get into this situation, but once they got into the situation, here's your choice. You can either give them a chunk of money and keep them in business or not. And if you don't, then what happens is you get these institutions that are $1 trillion in total assets. It just, boom, they're gone. And when they, boom, they're gone, then that means, oh, there's a panic. Now everybody that's given money to other financial institutions go, hey, that could happen to me. If that $1 trillion institution can be wiped out just like that, we'll wake up on a Monday morning and there it is in the newspapers, said that bank's gone. If that can happen, then any bank can be gone. You know what? I think I just better get my money back away from those banks. And so then it would be the same kind of panic that was underway back in the 1929 through 33 period. I want my money, I want my money. I don't trust this bank to hold on to it. I won't get it back if I don't get it today. Bank panic, financial system shuts down. Great Depression. So let's make a distinction. Do we give this money to these big institutions because they're nice guys and deserve it? No. Not nice guys, I think. Don't deserve it for sure. I mean, why would average Americans hand over money to rich people? You wouldn't. That couldn't be justified. But do it because if these institutions start failing, then it's what we get is a financial panic that ends up with a Great Depression where the unemployment rate's 25, 30%, and everybody goes, why didn't we stop that from happening? And so temporarily hand them the money. And that's what we did do, and I think that was the right move. I think it's a sad thing and shows mismanagement by the financial institutions and not careful regulation where we ever got to that point. But we did arrive at that point, and then you can't go back and change the past. The question is, what do you do today? Let's, probably won't finish today, but let's turn our attention to a couple of other related issues to what we've been talking about before we finish this discussion. It'll probably be a little bit into tomorrow, but we'll finish the discussion then. Other. There's other. That's just a nice heading for whatever I want to talk about. GSEs. Government sponsored enterprises. Let me see if I can set this up where it doesn't seem like just these random topics, but it's kind of related to what we've been talking about. Here's what we talked about before, asymmetric information. There are problems in this whole lending business that we as individuals cannot cope with. Okay, asymmetric information. And we talked about moral hazard problems, right? And this sort of stuff. So anyway, what we do is we say, well, we'll have some specialists who make loans. And they'll deal with asymmetric information. And those specialists were the banks. Well, the banks can do a better job, I mean much better job than we can in dealing with asymmetric information, but that doesn't mean they're perfect. And so there are still some, quote, deserving people who that if we had all the information, if it were symmetric and we had all the information in the world, we would make a loan. But banks are not making those loans because they don't have all the information in the world. And so there's still some, quote, deserving borrowers out there that aren't getting loans. And so what the government says is, hey, in those rare cases, let's us get involved. Let's us, the government, get involved. And we're going to help some people out here, people and businesses and so forth, get loans that they can't otherwise get. I'll come back to it later, but think in terms of a student loan. It's hard for students to go out and get a bunch of loans, and I mean enough money to go to college. Now, if your parents will give you the money, that's different, but that's not what we mean by a loan. That's parents. But if you have income of $5,000 a year, and you want to borrow $50,000 to go to college, who's going to lend you $50,000? And you go, well, I'll pay you back later. When? Well, several years from now. Well, how much will you pay me this month? Nothing. Next month? Nothing. Next 4 years? Nothing. Okay, so I'm going to lend you $50,000. You're not going to pay me anything for 4 years, at least. You're going to take this money and go have parties. And then I'm going to hope that someday you get a job and pay me back. The answer is no. There'd be no student loans, or practically none, if you just had to go out there and compete in the marketplace. And I mean, bankers want to make loans. They make profit from making loans, but bankers will just go, I don't know. Some people are going to pay us back easily, and others will never pay us back. I don't know. So then what we have is a government-sponsored enterprise, but the government is set up to basically help those student loans. Well, anyway, I'm just giving you a for example there as why there's still some, quote, deserving borrowers out there that are not getting loans, even through banks with the expertise they have. Let's talk about homeowners. I mentioned students, small businesses, those are the big ones. I believe I already talked about this acronym, the Federal National Mortgage Association. Have I mentioned them before? Yes? No? And then what we do is take that first letter, FNMA, from each word, and create an acronym. Now the next thing we do, and this is kind of funny, but by the way, this organization was set up, I believe, in 1938, so it's been around a long time. So the next step we do is, what does that acronym sound like if we were to just say it? FNMA. Oh, Fannie Mae. And so a lot of these organizations have got their acronyms. There's a Fannie Mae, and I'm not going to list them all, but there's a Fannie Mae, there's a Freddie Mac, there's a Ginnie Mae, the Student Loan Marketing Association, Sallie Mae, okay. But we've got these government-sponsored enterprises that are helping to get credit into the hands of these, quote, deserving people and companies. And we're going to talk about them a little bit next time. And I'll see you then. So long.